you spend 3 hours scanning the charts, looking for it. The perfect entry. The exact bottom of the pullback. The precise breakout candle. The indicator cross that confirms the confirmation of the confirmation. You think if you can just nail the entry, if you can buy at the absolute perfect price, you'll be a genius. You'll prove you can read the market. You'll validate all those hours of study. You'll finally be right. And when you get that perfect entry, when price bounces exactly where you predicted and you're up 1 hour within minutes, you feel it. That rush. I nailed it. But here's what happens next. Price keeps moving. Your perfect entry turns into 2R, then 3R, and you close it. Not because your target hit, not because the structure broke, because you were scared it would come back. You got the perfect entry, and you walked away with crumbs. Meanwhile, the guy who entered 10 pips worse than you, the guy who was late, he's still in the trade. He's holding. And 3 days later, he closes at 10R. Same trade. Worse entry. 10 times the profit. Let me tell you something that's going to sting. The entry is only half the trade. Actually, it's less than half. It's the easy half. Any amateur can get lucky with an entry. Any beginner can stumble into a trade at the right price. That proves nothing. Jesse Livermore, a man who made and lost fortunes multiple times in the early 1900s, learned this the hard way. And before he put a bullet in his head in 1940, he left us this. It was never about how I got in. It always was about when I got out. Read that again. Not how smart his entry was. Not how perfect his timing was. When he got out, the decision to enter gives you risk. The decision to exit or to sit gives you profit. And most of you are obsessing over the part that doesn't matter. Livermore is famous for one sentence. You've probably heard it. You've probably nodded at it and then completely ignored what it actually means. It never was my thinking that made the big money for me. It always was my sitting. Not his analysis. Not his market predictions. Not his genius for spotting patterns. His sitting. His ability to stay in the trade when it was working. Let me be clear about what sitting actually means. Because there's sitting. And then there's sitting wrong. Sitting right means staying in the trade when the market is confirming your thesis. Price is trending in your direction. Structure is holding. The move is clean. You're profitable. And every instinct in your body is screaming at you to take the profit before it disappears. Sitting right means ignoring that instinct. Letting the trade breathe. Trusting the process. That is where the money is made. Not in the entry. In the patience to let a winning trade become a big winning trade. Sitting wrong is something completely different. Sitting wrong is staying in a losing trade because you can't admit you're wrong. Price broke your structure. Your stop got hit. The thesis is invalid. And you're still in the trade. Not because you're disciplined. Because you're hoping. You're praying it comes back. You're negotiating with the market. You're turning a defined loss into an unlimited disaster. That is not sitting. That is stubbornness. And there is a word Livermore used to describe traders who sit in losing positions. Dead. Hope is not a strategy. Hope is a prayer. And the market does not answer prayers. The market does not care that you need this trade to work. It does not care that you cannot afford another loss. It does not care that your account is on life support. It moves. And if you are sitting in a losing trade hoping it reverses, you are not trading. You are gambling with a position that's already proven you wrong. So when Livermore talks about sitting, he is not talking about hope. He is talking about the discipline to stay in a winning trade when your fear says to leave. Now let's talk about the exit nobody discusses. The most important exit you will ever make. The exit from temptation. Livermore said something that breaks most traders' understanding of what exiting means. Sometimes the right exit is refusing to enter. Read that slowly. The exit isn't just closing a trade. The exit is standing aside when there's no valid setup. Let me explain why this is the hardest exit to take. You scan the charts. Nothing qualifies. No A-grade setup. No fresh demand zone. No clean structure. Your rules say, do not trade. But you've been sitting there for 40 minutes. You feel like you need to do something. Your brain equates activity with productivity. If I'm not clicking buttons, I'm not working. If I'm not working, I'm wasting time. So you start manufacturing reasons to trade. This one is close enough. I'll just take a small size. It's probably fine. And you enter. Not because the setup was there. Because you couldn't sit with doing nothing. You just took the wrong exit. You exited discipline and entered temptation. And that trade, the one you forced because you were bored, that's the one that destroys your week. Livermore understood this viscerally. Standing aside is not neutral. Standing aside is an aggressive position. It is the position of refusing to participate in a market that isn't offering you an edge. It is the position of preserving capital so you have ammunition when the A-grade setup actually forms. Amateurs confuse activity with productivity. They think being flat means being lazy. Professionals understand something different. Doing nothing is often the most productive thing you can do, because it prevents you from bleeding capital on mediocre setups. It keeps you ready for the trade that actually matters. Standing aside isn't waiting. It's working. You are actively protecting your account from your own impatience. And that protection is worth more than any forced trade will ever make you. Now, let's talk about the exit everyone thinks they understand, but almost nobody executes correctly. Closing a winning trade. You're up 5R. The trade is still moving in your direction, but it's been 3 days. You've been watching it. You're up more money than you've made all month. And the voice in your head is getting loud. Take it now, before it comes back. And you close it. The next day, it runs to 15R. You just left 10R on the table because you couldn't sit. Here's Livermore's rule on this. And it sounds insane when you first hear it. I would rather sell too early 100 times than sell too late once. Wait? Didn't we just say sitting is where the money is made? Yes. And this is the paradox you have to understand. Selling too early means you leave profit on the table. That stings. But you walk away with realized gains. Money in your account. Capital you can deploy on the next trade. Selling too late means you rode the entire move up, felt like a genius at the top, and then rode it back down. You exit with a fraction of what you had. Or worse, you exit with a loss on a trade that was once massively profitable. That doesn't just cost you money. It costs you psychology. It breaks something in you. The regret of holding a 10R trade back to break even is more damaging than the regret of closing at 5R and watching it go to 10R. One leaves you whole. One leaves you shattered. So Livermore's rule is this. Don't try to sell at the top. Selling at the top is luck. Selling before the disaster is discipline. And discipline compounds. Luck doesn't. You don't need to catch the entire move. You need to catch enough of the move, repeatedly, without blowing up. That's the game. Not perfection. Consistency. Here's your assignment tonight. Pull up your last 10 trades. Look at them honestly. How many of them lost because your entry was bad? Really? How many failed because you bought at the wrong price? I'll bet it's 1. Maybe 2. Now ask the harder question. How many of them lost because you stayed too long in a loser? How many lost because you exited a winner too early? How many lost because you forced a trade when there was no setup just because you were bored? That's where the damage is. Not in the entry. In the decision to sit. Or the failure to sit. Or the refusal to sit aside when there was nothing to do. The market does not reward intelligence. It doesn't care how well you analyze the chart. It doesn't care how perfect your entry was. It doesn't care how many hours you studied. The market rewards one thing: the discipline to leave. To leave a winner while it's still winning. To leave a loser before it becomes a disaster. To leave the screen when there's no valid trade. That is the skill. Not the entry. The exit. Most traders spend their entire careers perfecting their entries. They backtest entries. They optimize entries. They add indicators to confirm entries. And they stay broke because they never learned to sit. Livermore made millions, lost millions, made them again. The wins came from sitting in the right trades. The losses came from sitting in the wrong ones, or entering when he should have stood aside. The pattern was clear. The entry was never the problem. Master the exit, and you master the game. Not the entry into the trade. The exit from the winner. The exit from the loser. The exit from temptation. All of it. That is the decision that decides your future as a trader. Not how smart you are. How disciplined you are at leaving. The market yields to no one, but it pays those who know when to walk away.